Hi, I'm Stephen Carson coming at you from St. Louis, Missouri, in these United States. One of the things that bothers me a little bit about the style of our streams, I just everybody's streams, is that you tend to have this very sort of artificial studio environment, right? I mean, I've got a green screen and so forth. What you don't know, and I've been trying to figure out, like, how can I share this on the show? Right outside my window of my office here is Fiona the pony, who is up from the pasture, being kept in the dog yard, which is right next to my office because we cut the grass and she got a little too excited about the green parts of the grass and got herself a little sick and had to be taken out of the pasture. She is often up here for that reason, or well, that was the first time for that, but she'll be up here because the twins are gonna do some writing practice on her with my wife, of course, um, or something like that. So anyway, I sit in my office and it looks like I'm in nowhere, right? It's so artificial. But I'm sitting here with my family coming in and out, and the pony out there, occasionally passing by the window. Anyway, so that's a little peek into my life. Okay, so shortest show ever. If you want to support the show, and I hope you do, please look in the video description. Most supporters do $5 a month. I am not ashamed of asking for support because for decades it has been my practice to support the content creators that I love, because I know that that's how this stuff happens. We don't have billionaire backers, not dissident types. We don't have billionaire backers and Coke, the Cokes or the governments, right? The reason this stuff happens is because each of us gives a little and keeps our favorite content creators going. So I am not ashamed to ask. All right, we are getting to another Econ Minis. Took a break last week, and normally we would have gone back to the Left Wing Terror series, but Black Horse, who I will bring on right now. Oops, nope, not that one. There we go. Black Horse said, "This is a good week for us to catch up on current events because a few interesting things have happened." In fact, Black Horse, I'm a little surprised. There was a central bank, a Fed action or something, right? Which we're not even planning to cover, but that also sounded like an interesting. Can you comment briefly?
Yeah, the not the U.S. Fed, the Bank of England.
Oh, right.
So,
Sorry. Yeah.
um, as our listeners are no doubt aware, central banks around the world have been raising interest rates and engaging in a practice called quantitative tightening over the last 4 to 6 months.
And
And quant
the idea would be that if they don't, there's a threat of very serious inflation. We've had inflation, but like, well, at the worst, hyperinflation, right?
Yeah, in their worldview, what they're trying to do is take inflation back down from, the 8 to 12% levels that it's running at in the various jurisdictions,
Mm-hmm.
and try to pull it back down to their target levels. I think the official target for U.S. inflation is 2%. So they've been raising rates, they've been quantitative tightening, and they have, as a consequence of all of this activity, created problems in the financial system in a lot of respects, some of which we'll talk about when we talk about Credit Suisse and Deutsche Bank this week. But one of the interesting consequences of this has been a run on European currencies, in particular, in this case, the pound.
Right.
Uh, and
Oh, wait,
so
I'm sorry. Run on the pound. The pound has been devaluing relative to the dollar, right?
quite rapidly, which is
Yeah.
kind of counterintuitive for an environment where you're raising interest rates. Because normally, when you raise interest rates, what that does is draw capital from elsewhere in the world into your jurisdiction. But in this particular environment, where all the central banks are raising interest rates at more or less the same rate, raising interest rates doesn't have the effect of protecting the pound that it would otherwise have. And at the same time, you've got this situation where through quantitative tightening, you're putting into jeopardy the repayability of UK gilt debt. Gilt debt
Mm-hmm.
is their inflation linked bonds. And so, um, the fact that rates are going up more quickly in the U.S. is driving the FX markets. Um, and there was like a a minor catalyst in Parliament this week about changes to the tax code
Right.
that sparked a pretty hard sell-off in the pound and a pretty hard sell-off in the bond market. And
And they were
the
saying that they were that close to everybody's retirement in England getting completely wiped out, right?
well, they were close to a genuine run on the pound, right?
Right, right.
So this is a piece of lore or on Canadian economic history that most people probably don't know. But in the early 90s, Canada ran into a similar problem with debt and was unable to market debt in Canadian dollars. So
Mm,
at the time, what the Canadian government did is they started selling debt denominated in US dollars, which meant that devaluing our own currency was not an escape from our fiscal problems. And
mm-hmm.
magically after that, our parliamentary class got religion about solving our fiscal problems. A similar kind of thing is going on in the UK as a larger and larger proportion of their national debt is sold in inflation-linked notes.
Mm.
So the inflation-linked notes, as the inflation indexes they're linked to tick up, are starting to bear a lot of interest.
Okay. So
And
let me say this back because what the traditionally, well, especially in the U.S., which is always a special case in these things, right? Because of the Fed or because of the position of the dollar globally. But
yeah,
the traditional story is, hey, we're borrowing it from ourselves. Also, we can just print money and pay back any amount of debt, right? But you're saying that
yeah.
once you get inflation linked, that trick doesn't work because if you inflate the currency, your debt just balloons along with your inflated
Yes, your
currency.
debt
And
payments balloon along
yeah,
with the currency supply.
right,
So
right.
it's a
And
problem.
the old traditional escape hatch is gone now for them.
Yes. At least to some degree. So you can
Right.
look up the size of the payments on the gilt notes, and the payment that they had to make on the gilt notes this week was like 3 or 4 times as large as any payment they've ever had to make in like the 5-6 year chart I was looking at.
Mm-hmm.
It was quite substantial.
And
So the central bank,
unsustainable if it kept going like that is the point.
yeah, well, so the central bank came in and bought a whole pile of their own paper back in order to stabilize the debt markets and sort of stabilize the currency markets. But I would say that that's a story that's very much still playing out.
Yeah.
And
Right.
probably 2 weeks from now is a better time for us to come back and cover it in
Sure.
detail.
Right.
Because I think
It's worth
the
mentioning now, right?
currents,
Because our theme is the fragility today of the monetary and banking system. And it seems like this little scary moment in England is a great symptom of the fragility we're talking about, right?
yeah, yeah, absolutely, absolutely.
Just nuts. Okay, so before we get back to more of these sort of, large, sort of, globally impacting financial things, let's peek in on what is, fair to say, Black Horse, from a financial markets point of view, a rather minor little blip. It's just particularly interesting to those of us who are sort of internet denizens, right?
Yeah,
Going to the first story, and that is that we had done a few updates on the following along with the Twitter deal, with the benefit of Black Horse having some knowledge of sort of how these sorts of hostile takeover type things go. And so he was able to kind of give us context and help us talk us down from some of the crazy things people were saying. And very often just say, well, that's just kind of how these things go. It's not actually that weird, even though it's Twitter and it's Elon Musk, right? There's sort of uh, there's drama around Elon Musk. There's drama around Twitter, but that doesn't mean that the actual business deal is really that different than any takeover of some company you've never heard of, right? Um,
yeah, yeah, yeah.
right. But having said that, here we go again, and they were headed towards court because Elon Musk said, "Hey, you guys have not solved your bot problem. You made a material misrepresentation that bots were, I forget, less than 5% or whatever of users.
Yeah.
And we have darn good evidence that it's way worse than that. And so the value of a social media company is to some degree based on, like we say, if you're not paying for it, then you are the product, right? So when you use
Well,
Google search, when you use Twitter, and you're not paying them any money, Well, that means we are the product. Well, if we are the product and there's a lot less we's than the company says there are, then they're
Yeah.
not worth what they're representing themselves as being worth, right? So Twitter says, hey, we have this many. The industry terms are like daily active users, monthly active users, that kind of thing, right? These are the people who these are the number of eyeballs who have attention on our site, and you could get their attention, advertiser or whatever, if you come to our site. Well, if a bunch of those are bots, they're not human eyeballs,
Their
then the
attention is not
companies,
valuable.
yeah, their attention is not valuable, and you, the advertiser, whatever, getting scammed. So that was
Yeah.
Elon Musk saying, okay, you guys are not worth what I originally offered. This is ridiculous. And then they're going to go to court over it. And then, do you have any theories? Suddenly, Elon Musk, before the court date,
Well, so they
says,
actually
actually,
did
let's just go
get
with the original
to
deal.
they actually did get to the early stages of civil court. So you
Oh,
may have
okay.
seen over the last month a bunch of leaks coming out of the discovery process of all kinds of communications. Most of the
Right.
leaks that became prominent on social media were leaks of Musk communicating with various figures, but there was also a whole pile of leaks of Twitter internal communications. And the way that I read this is they got through the early discovery process.
Hmm.
Um, they got kind of embarrassing stuff out on Twitter, but Twitter's basic defense through this has been we don't actually has been we measured the bots in this way, and we don't actually have any better number. So because we're ignorant of any better number, we weren't making a misrepresentation,
Uh,
uh, which,
in
as
other
far as I
words,
can
in
tell
other
from
words,
the
we're not denying there's more bots. We just don't have any way to tell if there's more bots.
That's right.
Right.
And as far as I could tell from the discovery process, that position actually seems to be correct and
Hmm.
relatively tenable from a legal point of view.
Got it. Even though it
There's
feels
no legal standards.
a little bit ridiculous to us, right? I mean, it really feels like
Well,
they're
there's no
kind of
legal
lying in
standards
a
for
way.
how you have to measure bots, right?
Hmm.
Daily
Right.
active users is not a it's the SEC has no definition of a daily active
Right.
user.
Right. Right.
So uh, it's very, very hard to litigate on that basis.
Got it. Yeah.
So, based on what came out in Discovery, it's reasonable to believe that it was going to be a difficult legal battle for Musk in order to kind of
Mm.
in order to alter the price of the deal. And
Right.
so this is appears to be the result. The deal is
Got it.
apparently going ahead at the original price.
Yeah. So just reading from the Wall Street Journal here, Elon Musk has offered to close his acquisition of Twitter on the terms he originally agreed to. That is $44 billion deal, right? And then I thought I had seen that, yeah, original price of $54.20 a share. Yeah, what is the Twitter price right now? I remember you said that that is a
Oh,
quite.
it's like 30. It was like $30. So it was a very significant discount going into the acquisition.
Oh, that's interesting. Oh, well, it's at 49 right now, but
Yes. So the fact that it's at 49 indicates it's extremely likely that the deal will conclude
okay,
on
yeah,
the
yeah. But when was this story? October 4th? Okay, yeah, I see the jump on October 5th, which is yesterday's trading, um, where it
yes.
goes from more like $44 up to near 50, right? So
Yes.
yeah, this story
Which
came out
indicates that
and yeah, yeah,
it's very likely that the deal will come together on these terms.
right. Yeah, so we are seeing Elon Musk taking over. Um, So you did you follow? You mentioned it, but did you actually read some of those revelations? Because people are trying to read a lot into it, and I think that's a little bit dangerous, right? Because Elon Musk chatting with Jack Dorsey about ideas of how Twitter could be different is not the same as what Elon Musk will necessarily do once he actually buys Twitter, right? And he's just talking. But did you
Yeah, I mean,
come
when you're
away from that
reading
with anything substantive?
when you're reading documents in discovery in a lawsuit like this, you've got to remember what those documents were surfaced to do and how they're being presented to you.
Hmm.
So those documents were surfaced by lawyers in an attempt to do one of two things: either prove their case or embarrass the other party.
Right.
And then they were filtered out via media companies that are sort of quote mining the
Yeah.
discovery to try to get a story. So
Right.
you're
Get
not
clicks. Yeah.
seeing the complete context of business discussion about what Musk will or won't do with Twitter.
Right.
So I wouldn't put a lot of stock in his comments talking with Jack Dorsey about how Twitter could be run.
Hmm.
Um, I would wait and see what he actually does.
Yeah. Yeah. Right. So you did not look at any of that and go, "Oh, okay, that's surprising. He's going to do this." You're taking a wait and see on any of that kind of stuff, right?
Yeah, the piece that came out of Discovery that was more interesting to me was the pieces that came out about Twitter itself.
Mm,
The the way the leaks that came out were circulated on Twitter pretty widely as indicating the incompetence of of their management,
mm-hmm.
and it was very interesting to me that Twitter's legal team was able to kind of leverage this to their advantage, right? By arguing basically that there was no means at Twitter's disposal technically to figure out how many bots they actually had,
Right. We just don't
right?
know.
So their
We
argument
can't
was
figure it
basically
out.
our technology is yeah, exactly. Our technology is sufficiently bad that we don't know this number. Ergo, we didn't maliciously misrepresent it to you.
Nice.
And then every comment that gets leaked to the media about how incompetent they are actually strengthens their legal defense. So it's kind of an innovative tactic from their lawyers.
Yeah, oh no, I mean, I've heard this sort of thing before. The lawyer comes to you and says, "Okay, now I'm going to be putting you in a rather unflattering light, but it's going to save you a lot of money." And unless someone's got just a massive pride, they very quickly go, "Okay, put me in an unflattering light. I don't care." Right.
Yeah.
Uh,
Well, and
we're
as far as I
the
can
days
tell, it looks
the
like
days of
all of
personal.
Twitter's internal management is going to get canned anyway. So who
Right, right.
cares?
The days of personal honor where you would be like, no, no way. How dare you besmirch my honor just so I can save a few shekels? Those days are gone, what, 100, 200 years ago since people thought that way, right?
A long time ago, yeah.
Yeah. Okay. Anyway, so again, returning to the theme that I noticed you kept hitting on as we covered this story, um, it actually has not gone, despite the drama, despite sort of a lot of us having a lot of interest in both Elon Musk and Twitter. The actual way this business deal has gone is not particularly shocking you, just from the perspective of other kinds of buyouts and hostile buyouts and stuff, right?
Yeah, it's pretty common to have a court case go on while a negotiation is made. I
Mm-hmm.
was somewhat surprised that the price went through as originally um, written in the deal,
Mm-hmm.
but um, I've that is also not unheard of.
Yeah, you thought he might negotiate it down a little bit with some of his tactics here, and it didn't happen.
Yes.
Um, oh, so before we leave this, a lot of people are, and I notice people do this, and I'm always feel cautious. People are injecting their hopes and dreams into this, right? Uh, we're back, boys. It's gonna be the Wild West once he takes over, and it's gonna be great. It's gonna be the good old days are back again. The wild and free internet. Um, do you have any comments, any opinions? Not so much from your own hopes and dreams, but what Elon Musk might be up to from a business point of view. I mean, I guess some people are just thinking that he's sort of making this altruistic move to bring free speech back. But as we see in this article, he's got other fish to fry for sure. He talks about this X app. Where was that? Um, yeah, here we go. Buying Twitter, Mr. Musk tweeted Tuesday that buying Twitter is an accelerant to creating X, the everything app. Um, he has previously indicated that the name X.com applies to a social media company he might create if the Twitter deal didn't happen. But now he says buying Twitter expedites that project by 3 to 5 years. So in other words, he's got some business plan here. He isn't just blowing money to virtue signal. He's got some idea of Twitter being a piece of some bigger project he has in mind, right?
Yeah, so it appears. I mean, I think we'll probably get like the Babylon Bee back on Twitter and maybe a few other things, but
Mm-hmm. Right.
uh, he very clearly has. I mean, one of the things that came out in Discovery is repeated comments by Musk that Twitter should be a technology company and not like a news editorial business.
Mm-hmm. Right.
And
A
I think you'll see
platform,
a
a tech
tilt back,
platform. Right. Right.
a tilt back to Twitter focusing on its technology, which, based on what we've seen in Discovery, looks like is actually pretty crappy.
Mm-hmm.
Um, and maybe that'll solve some of their internal cost problems. The other thing
Right.
I highlighted on my Twitter a few times is that Twitter as a company uh, has like really terrible earnings, and maybe some restructuring of the company for that reason might be in order.
Right. Yeah, they don't make money. Uh, and you'd think he would want to make a sustainable business out of this somehow. Um, yeah.
Yeah,
Okay.
well,
I'm
I think if you fired some censors and hired some tech people, maybe it would be better.
right. Right. I'm going to stick my neck out as we look to the future of Twitter and say that if Elon Musk completes the deal, which it's now looking pretty certain he will, all these people who are I guess lefties or regime aligned people, I don't know what to call them, all these people who are saying that, we're leaving Twitter if he takes over. I think there will be about as many that leave Twitter as immigrated from the United States when Trump was elected. Um, where
Yeah,
they
well,
also
as a
they also
Canadian,
threatened they also threatened that if Trump got elected, they were out of here. I mean, they're not going to leave Twitter either. That's my little humble
yeah,
prediction. I may be wrong, but there you go.
I mean, as a Canadian, every time a right wing president or a Republican president gets elected in the U.S., we always hear, I'm moving to Canada.
Hmm.
There are very few American refugees in Canada.
Right. Now, during the Vietnam War, where you were avoiding the draft, that really did happen. I mean, I know people, right? But
Yeah,
but yeah, this other stuff,
there
no, not so much.
there are very few Donald Trump refugees in Canada. Very few.
Right. Right. So yeah, I don't believe them. Okay, there's my little prediction. All right. Well, now let's move to our headline story, which is that some interesting things have happened with two banks. I guess first thing that you can bring with your knowledge of financial markets is we're going to talk about Credit Suisse and Deutsche Bank. Just give us some context about why do we even care about these banks? Because I think it goes a bit beyond what you would see if you just like, I don't know, look at their capitalization. What you were telling me
Yes.
about is that they are functioning in certain key ways in the international, I don't know what you call it, banking system or financial system. And that is why these stories are particularly interesting to us, right?
Yeah, so Credit Suisse and Deutsche Bank are two of the largest financial institutions in Europe, and very significantly, they are two of the largest players in the derivatives market internationally. Um, the derivatives market is well, it's a broad term. It refers to a set of markets for contracts between financial institutions, particularly. So, if you looked at Credit Suisse, you'd see that they have a very significant position in the international FX market, where they're writing things like contracts for difference, swaps, uh, and other derivatives products around foreign exchange. And one of the interesting things about uh, derivatives of this kind is that they're not traded on an exchange, and many of them involve counterparty risks. So when you trade a stock or when you trade an option or when you trade a future, you're dealing with a central counterparty, whether it's NSCC or OCC or the CME. Your financial risk is to the central counterparty, not to the other counterparty. When you
Okay.
trade an OTC derivative, very often your financial risk is to the counterparty rather than to the central counterparty,
And you told
which
me that
means that
there are attempts to centralize a little more that counterparty risk, but that is that's speculative. Today, that is not the situation, right?
yeah, ever since 2008, there have been efforts to particularly put the swap market through central counterparties.
Right, right.
There are a number of central counterparties in this business. there has not been significant financial strain since the efforts to put OTC derivatives onto central counterparties in sort of the early 2010s. So
Hmm.
this will be the first major set of, well, if these institutions fail, it will be the first major set of financial institution failures since the implementation of the quote living will doctrine in financial regulation, and since the centralization of counterparties in the OTC derivatives market. Now, uh, theoretically, that should mean that there's less consequence for the collapse of an institution like this, um, because those efforts are meant to prevent the collapse of an institution like Credit Suisse or Deutsche Bank from having systemic consequences around the financial system. Um, we're going to see very shortly, unless something quite unexpected happens, whether those mechanisms actually work as intended.
Yeah,
Um,
I actually don't know anything about what you're calling the living will. I mean, I know what a living will is on a personal level, but what does it
okay,
mean in the context of these big institutions?
so after 2008, when there was a set of disorganized failures of large financial institutions, regulators in the US and in Europe, uh, after having taken large stakes in financial institutions, getting board seats, and dictating to them how they must be managed, set up a series of regulatory imperatives designed to create a mechanism for orderly bankruptcies for large financial institutions. So the idea was that in the '08 world, there was this problem they called too big to fail. The idea that if a large financial institution failed, there was no way to unwind the institution in bankruptcy court without causing the failure of other financial institutions. Well, the regulators looked at this and said, this is a really big problem. We need every institution to devise a mechanism for unwinding the institution in bankruptcy. And that's going to be its quote unquote living will. And we're going to audit this regularly. So every financial institution now has uh, a number of liquidity plans and a living will that's supposed to dictate to the regulator how it should be unwound in bankruptcy court if it fails to meet its capital obligations.
Got it.
None of these living wills, to my knowledge, have ever actually been executed.
Yeah.
God only knows if they're actually sound.
Right, right. Yeah, it's an attempt to put something new in place that had not been um, present in the financial markets, right? To deal with crises like the 2008 crisis, but we've never stress tested it. It's your point, right?
That's right. We've stress tested it on paper. That's
Right.
very different than an actual unwind.
Yeah. I just wanted to shill our 2008 Meltdown series, Black Horse, guided us through what happened 15 years ago now. I'm just putting that in the super chat. It's three streams we did walking through that. And Black Horse was just referencing some of those things. But what happened 15 years ago, there were a lot of things changed as a result of that crisis. And so we walk through the crisis and the changes to the structure of the financial system and regulations and the role of the Fed and many things like that that resulted from that. So if you have interest in that, really worth watching through that series. You will learn a lot that will inform your understanding of how things are today, like what we're talking about right now, right? These attempts to, next time we'll be ready for it. How many times have we heard this?
Well, we're going to see, I suppose.
Yeah, right. Okay, so oh, and by the way, you said it, but for me, derivatives means futures and options and so forth. But this is an aspect of the derivatives market that has more to do with, what'd you say, foreign exchange,
Yeah, so
right?
there's three big categories of OTC derivatives that are that you'll see. There's swaps, there's foreign exchange, and
Hmm.
there's like, well, there's credit default swaps, there's interest rate swaps, and there's equity swaps, and then there's foreign exchange, which can be
Okay.
done as swaps or contract for difference or there's a few other flavors of that.
And Credit Suisse and Deutsche Bank would be players in all of those categories you just named.
That's correct.
Okay, got it. And not just players, but okay. And I'm sorry, I did mean to clarify this with you. Are they players globally or within the context of Europe?
Globally.
Okay, okay. So
So
you
like
would
Credit Suisse would have one of the larger franchises for OTC derivatives on Wall Street
okay. So U.S. Stuff is going to go through there just
as
as
well.
much as German. Uh,
Yes. And some
right.
of that has to do with the different regulatory environments in the US versus in Europe. So the existence of their very established position in the European markets has given them competitive advantages historically in the space.
Got
But
it.
that's a
Okay.
deep rabbit hole to dive into. So
Okay. So now turning to what actually with that context, turning to what happened quite recently, right? This is all. Is it this week? Where
this week, yeah.
yeah, this week, Credit Suisse and Deutsche Bank. Well, what happened? Their shares dropped, or what was the thing that got people starting to freak out?
So this is really interesting. So if you look at the event, you'll see a series of articles like this one from CNBC that basically say the stock went down and the credit default swaps went up. It looks like they might be going bankrupt. But the articles say absolutely nothing about why. And the reason they say
Mm-hmm.
nothing about why is because the the stock is dropping based on undisclosed rumored losses in the derivatives market. So people are watching what's happening with the FX market in Europe and concluding from that that the derivatives units at Credit Suisse and Deutsche Bank probably are going to print very, very large losses.
Got it. Okay.
And then you'll see some articles that are paid for articles, obviously paid for by people in the European financial industry, talking about Credit Suisse's good liquidity coverage ratio and its long-term liquidity and all of this stuff,
Yeah. Yeah.
um, which are all backward looking at the last quarter when the last numbers were published to the regulator, right?
Right. Right.
So what happened this week? Well, not from a in terms of public data, nothing.
Mm-hmm.
Uh, People are making speculation based on what's going on in other markets, what is likely to happen with losses from their capital markets units.
Right. Okay. But here's how this sounds to me, and tell me if my layman's view is off. When I see nothing official, but there's sort of a shaking of confidence, and then people start to freak out that these banks are going to collapse, that tells me that they can't be that sound, right? Because
Yes.
if they were
Well,
really
this is why.
sound, then a little unsubstantiated rumor would not cause them to plunge 10% or whatever, right?
Yeah. Well, in the marketing, we opened with how did you go bankrupt? Slowly and then all at once.
Right, right.
Well, this is very much the story with Credit Suisse and Deutsche. So I wanted you to pull up the stock charts
Yeah.
for each of them, and we'll kind of go through.
Okay, now is
This
this
is
the first chart? Credit Suisse Daily, right?
Yeah, this is Credit Suisse 5 years.
Okay.
So this is being presented in the media as an event which has occurred kind of singularly in the last week. But if we
Mm.
look at that chart,
There's a
that's
certain
not a
trend.
1 week event.
Yeah, there's a certain trend there. Yeah, and by the way, I find this really interesting. And I'm curious how you think about it when you're assessing these sorts of things. If you narrow your focus to say a 12-month period, you can tell a story like I'm just picking out a 2020 to 2021, somewhere in there. It shows it going up, right? So
Yep.
very much the period of time you focus on can like tell different stories. Um, and maybe that's because well, we know 2020 to 2021 was a weird time because of lockdown measures and so forth, right? Um, so how do you deal with that? How do you tell the flutters from the long-term trends? Did you follow me?
Well, if you could answer that completely, you would be extremely rich in the capital markets, right?
Right.
But typically, the longer the chart you're looking at, the less that the stock price is going to lie. right?
Yeah,
Over a
right,
very
right.
long period of time, the stock price is going to reflect the underlying earnings.
Yeah, yeah.
And
As opposed to
the shorter the
as
period of
opposed to
time you're
world
looking at,
events and stuff. Yeah.
yeah,
Right. Right. So when you look at a 5 year and you see the flutters in 2020, 21 and so forth, but you kind of um uh I'm sorry, what's the word? Squint. You squint and you're like, I see a certain trend line there. You start to feel real concern, right?
yeah, yeah. And I mean, I could have pulled the chart of their earnings as well to add to
Mm-hmm.
this,
Yeah.
but needless to say, they've not been good over the same line.
Right. Do you want me to jump to the Deutsche Bank chart before we hit the
Yeah, why
other
don't we do the
credits?
Deutsche Bank
Okay.
chart now
Yeah.
as well, because we can see
So
a similar kind of pattern.
again, okay, wait, this is a longer time period, it looks like,
Yeah, this is a
right?
10-year chart
Okay,
because
sorry, back
the
to the,
decline of
yeah.
Deutsche Bank goes back a little bit farther.
Right, right,
Um, so you can see actually the worst period for Deutsche Bank's business is not like I mean, the stock's gone from $14 to like $7 in the last 7 months, but this was a
right.
$40 stock 10 years ago.
Yeah, 10 years ago it was $40. Yeah, right, right. So they've taken a real dive.
Yeah. So this is what's going on in the last couple of months is an attack on businesses that were um, a business problem for businesses that were in long-term secular decline.
Yeah, gotcha. Right. Yeah, and
So
I mean, tell me. By the way, I don't really watch like Jim Cramer and I don't know the financial press. Um, do they have a tendency? This is just my guess. Do they have a tendency to be a bit short term in their perspective and sort of talk about the latest thing that's happened and not zoom out like this and get the longer term, like you call it, secular trend?
yeah, that's typically the case. I
Mm,
mean, they're going to talk about what the latest earnings report was.
right.
Very rarely are you going to see the financial press tell a 20-year story of a business.
Mm-hmm.
Um,
Gotcha.
it happens, but and when they do it, it's great, but
Mm-hmm.
it's not the norm.
Right. So, Deutsche Bank over 10 years down from mid 40s even. Well, $40, say, to last 5 years, it's been in the $10 range or something like that. Then back to Credit Suisse, 5 years ago, it was up in the like high teens, and now it's just gotten to like $4. So
Yeah,
these are not small moves. These are what are we looking at? They're dropping by 75%
yeah,
plus
70
or
plus
worse.
percent moves.
Yeah, yeah. So that's something to get your attention. And so, what does it say to you when you see that kind of a big move over 5 to 10 years in a financial institution like this?
Well, I mean, it says that their earnings are under long-term pressure. This is not this is representing a chronic problem with their business rather than an acute problem with their business.
Right. And just
And
to
what
clarify,
that CNBC,
those terms are really useful. So I want to make sure we're very clear with everyone what we mean. Chronic means like chronic pain, which we deal with in my family. Chronic pain means like it hurts every day. Acute means you stub your toe and it hurts for the day or for an hour, and then tomorrow it feels okay. So you're saying
yeah,
the press will tend to be a bit short term and say, oh, they're having a little flutter right now, but you step back, you look at this picture and say, no, 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 they've got a sustained problem with their business model or
yeah,
something.
they might have stubbed their toe today, but they also have cancer.
Yeah, that's a good way of putting it. Yeah, it's not to deny the acute, and in particular, I think what we sometimes see that gradually and then suddenly is that the acute becomes the straw that broke the camel's back. Right? That is, there was a long buildup, and then some little event comes along. If it's really fragile, it can be almost anything, right? And suddenly it just collapses. Not because of that event, really, but just that sort of a final trigger of a long series of uh, distortions in the economy, or in this case in the functioning of these institutions, right?
Yes. Yeah. So this kind of begs the question, what is the acute problem, given that we now know that these are institutions in chronic decline,
Right.
have been for quite some time? What are we actually looking at an acute level? Well, it, we looked at our news story, and the news story told us nothing, basically. You heard me nebulously talk about rumors that they might have lost money in the derivatives market.
Right.
Okay, well, why do you need to listen to me?
Right.
Probably the best way to judge these kinds of things is to look at the market indicators for the institution. So I pulled up two really powerful market indicators to look at the status of an institution. The first, actually, can we go to the options market first,
Okay.
and then we'll come to
Sorry.
the credit default swap market?
Okay. This one. Gotcha. Gotcha.
Yeah. So what we're looking at here is the market for options on the American deposit receipt for Credit Suisse. That's the U.S. Uh, listing of the stock. Um, brought For those who aren't aware, the options market trades either calls the right to buy a stock at a given price, puts the right to sell a stock at a given price
Mm-hmm.
for a given period of time. So I pulled out stock the options for December 2016, or sorry, 2022. Um, the highlighted row at $4 is the strike price right at the money. So that's the right to buy the stock at present price until December 16th, or the right to sell the stock at given price until December 16th.
Mm-hmm.
And the advantage of buying a derivative like this is that if you just buy the right to sell the stock, you don't have to sell the stock.
Mm-hmm.
So if the stock goes
That's
from
why it's called an
$4 to
that's why it's called an option instead of a contract, right?
that's correct.
Yeah.
And so there's a really interesting set of properties for option pricing that will provide some insight into the probability of future returns for the stock. So the way that options are priced is using well, there's a couple of different theoretical mathematical frameworks for option pricing. The simplest one is the Black-Scholes option pricing model, and it has as inputs the volatility of the stock, the current price of the stock, the risk-free rate of return, risk-free interest rates, and the period of time until the option expires. And the basic mathematics behind it are that you put the volatility into a statistical framework to predict the future returns of the stock. And then based on the volatility times the period of time to the expire of the option, you can come up with a value for the option to buy or sell the stock. So broadly speaking, if the volatility is higher, the option is worth more. If the period of time till expiry is longer, then the option is worth more. If the risk-free rate of return is higher, then the option is worth less. Then the option is worth more.
Mm-hmm.
And so we did volatility, and and then the price of the stock, obviously, depending on whether it's the right to sell or the right to buy, will influence whether the option is worth more or less.
Mm-hmm.
So what you can do is you can turn that around, and you can take the actual prices for the options that are trading in the market and compute what's called an implied volatility, which is the implied probability of a large change in price in the stock. So the implied volatility in the puts will give you a sense as to the probability, the aggregate wisdom of the markets as to the probability that the stock will go to zero.
Got it.
So the implied volatility of the at the money options here is 0.92, roughly equivalent to 92%,
Mm-hmm.
which indicates something like a 30 or 40% probability that the price of the stock will be zero before December 16th.
I'm sorry, 30 to 40%.
Yes.
Whoa, that's not good odds. Okay, what would be
Well,
for a sound company? What would implied volatility be for December? What would you want to see there, and you'd
uh,
feel confident?
so if you saw an implied volatility of on the put of like point 3, point 2, point 3.
Mm.
That would be what you would expect to see in this environment for a stock, and that would, in most cases, you're going to be weighting heavily the probability that the price of the stock will go down by a small percentage rather
Hmm.
than go down to zero.
Right.
One of the interesting things about this set of puts is that as the strike price goes down to from $4 to $2, so $2 would be a 50% loss on the stock, you continue to see significant pricing in the puts, which means the market is telling you that there's a significant probability that this stock is going to be less than $2 before December or 16.
Wow.
So that's what you're looking at here. You're
But
looking
wait,
at,
so in short, higher implied volatility is a bad sign for the stock, right?
yes.
And so what? Maybe this is going too deep, but real quick, I'm enjoying learning here. The over one implied volatility for strike price of $3 and $2. What does that mean when it goes over one like that?
So it means that the mathematics is breaking because the
Oh,
volatility
okay.
surface is not linear. So at the next level of sophistication of understanding options pricing, you'll realize that every option implies a volatility for the stock based on its strike price and term to expiry. And what you can construct out of that is a three-dimensional function called a volatility surface
Hmm.
that looks at the probability of returns at each strike price. So those very high implied volatilities for out of the money options uh, will reflect one of two things. They'll reflect a kind of lottery ticket effect where people won't sell options for zero price. There's kind of a psychological thing in pricing there.
Hmm.
Um, and then if they've got like significantly non-zero prices, like in this case, uh, they will reflect um, risks that are not evenly distributed. So this is telling you that it's more likely that the return will be like the stock will either stay close to $4 or go to zero, and it's less likely that it's going to be something in between.
Oh, okay. That's interesting.
And so that uneven distribution of probabilities leads to really strange results in option pricing that really
Right,
screws
right,
with the
right.
mathematics. So you
Gotcha.
see as the strike,
But a more normal, a less drastic situation would be a fairly low implied volatility at the current price, like you said, like a point 0.2 or point 0.3, which is going to show good probability that it's just going to kind of stay near this price. And then maybe you'd see a little bit more at $1 below, maybe because there's some concern that there's some
well,
weakness here.
you would
It's not going to go
typically
to zero,
see
but it might go down a bit, right?
once you get 10 or 15% out of the money, you'll get strange effects on
Mm,
option
okay,
pricing
got it.
uh, for most stocks. But if you look at the implied volatilities here, as you go up in strike price to 5, 6, and 7,
Mm-hmm.
you'll see that they're pretty consistent,
Right.
uh, which reflects this kind of unevenly distributed probability of stock returns.
Got it. Yeah, by the way, everybody, Black Horse asked me ahead of time, dare we do a little bit of a deep dive on this bit? And I thought you guys could handle it. So we won't go any deeper, but I found this really interesting. I know the term implied volatility, but I've never really understood what it meant. And and I guess what I'm curious then is, I mean, implied volatility is meant to be a little bit of a predictor, is what I'm hearing from you. So how does it work out in real life in your experience?
Well, so implied volatilities are set based on uh, it's almost like an insurance marketplace, right? Because people buy
Mm,
options in order to most options aren't bought to be held outright; they're bought to hedge positions,
right.
um, and so that insurance marketplace is historically pretty, especially for events like this where there's likely insider knowledge.
Mm-hmm.
That marketplace is it's a much better predictor of future stock returns than, for example, I am. So,
Hmm.
um,
Right.
take that for what it's worth.
Yeah. Anyway, but
Um,
point being that
it's
when
also
you
worth
see,
saying that
yeah.
in my entire sort of career in the financial industry, I support a lot of option market making desks that assemble these prices. I've never
Hmm.
seen any of them lose money, so
Oh
they're
wow.
quite good at what they do.
Okay. So this is like like you said, like insurance companies with their actuarial tables, right? They,
Yeah, it's they're
yeah.
they're quite good at what they do.
Right. Right. So in other words, when you see the at the money implied volatility is getting pretty close to 1.0, like this 0.92, um, you are not wanting to have your life savings in this stock, shall we say?
Well, I mean, you can have a situation where the implied volatility is jumping for the other reason, right? So you saw
Mm,
this all the way up with Netflix, where the opportunities at each earnings report for positive returns in the stock were so huge that
mm.
the implied volatility was very, very high.
Oh,
So you
okay. So
can
sorry.
see that.
So implied volatility tells you about a move. It doesn't tell you the direction of the move. Is that what you're saying?
Yes. Well,
Got it.
you can kind of infer it based on the distribution of implied volatilities across the surface,
Hmm.
but certainly it's not a it's a difficult thing to understand exactly what's causing the volatility surface to be shaped the way it is.
Right. But anyway, but you have other we have other context here for Credit Suisse that helps us interpret the implied volatility, right? Which is to say,
That's correct.
this large implied volatility, we don't think this means that Credit Suisse is going to suddenly triple its share price. That's not the
Yes.
direction it's headed.
Yeah. Well, and if it meant then you would see high implied volatility with strike prices above the current price of the stock,
Hmm. Hmm.
whereas you see stabilizing implied volatilities above the current price of the stock.
Right, right, and it's high on below as you go towards zero share
Yes.
price. Yeah. Okay. Thanks for walking us through that, sir. Very interesting to me for various reasons, shall we say. Um, okay. So shall we turn to the other chart, which
Yeah. So the
was
other metric here is so that
here we
metric
go.
tells us what we might expect the stock price to do and what we might
Hmm.
expect for returns for investors in equity. But there's another metric here that's very important, and
Okay.
this one's quite interesting because of the special relationship that Credit Suisse and Deutsche Bank have to the governments that regulate them. So what you're looking at here is a chart of the price of the credit default swap for Credit Suisse. Credit default swaps are an insurance product that provide insurance coverage for failure of the institution to pay its bonds.
Okay. Now this is going
So
to get really confusing and meta because Credit Suisse is a big player in the credit default swap market, but we're not talking about
yes,
the credit default swap market in general. We're talking about the credit default swap about Credit Suisse itself, right?
that's correct.
Yeah, yeah.
So
Okay.
this market is buying insurance for the eventuality that Credit Suisse will not repay its bondholders in full.
Okay, got it. Got it. And so you want to
So
see
what
something
you
near zero for a sound institution here, right?
yeah, so near
Yeah,
zero means that it's very unlikely that the bondholders will not be repaid.
right.
You can see that there's a spike there during the '08 crisis, another spike
Mm-hmm.
during the European debt crisis in sort of 2012,
Okay.
and a much more significant spike very recently.
Very significant spike. Whoa.
So a, a 500 basis point price for a credit default swap is an indication that there's a very significant probability that there will be debt restructuring on the bonds for the institution, which means bankruptcy court.
Right. Yeah, just
So
for those who might not be looking at the chart, we see it at like prior to the '08 crisis, it's near zero. It's hovering around zero, right? The '08 crisis, it actually jumps up quite dramatically to near 300. And then the 2012 crisis, it's about 150. And then this is looking more acute, you could say, right?
yes,
Suddenly, this week, I guess. Is that what that vertical line is? This week it just
That's
shoots up
correct. This week.
straight up from 150 to 500. So a really dramatic move, showing that people are very seriously concerned that Credit Suisse is not going to, well, it's going to be bankrupt, right?
And this is a classic pattern for institutions very, very close to bankruptcy, where
Right.
you
So
have this like,
so I'm confused. At first you said, well, there's nothing concrete that's freaking people out. Okay, well, okay. This is a symptom of people being freaked out, I guess, not necessarily a
that's
cause.
right.
Okay,
So this is
got it.
saying that
Okay,
people in the market think Credit Suisse is going to go bankrupt. This
right,
is
right.
not, we don't have a financial report from Credit Suisse. We don't
Mm-hmm.
have like any of that information. What we have is the information that the market is providing us about the speculative likelihood of probability of default.
Right. So sometimes it turns out, I assume you've seen this, the market freaks
Yeah.
out and then check it a week or two later and it's just whatever it was, it's gone and it just goes back to normal. Other times the market freaks out because something's going on. Something's about to go
Yeah.
down, right?
Well, especially in an instance like this, where it's very likely that there are a very large number of parties with inside information, uh,
Mm-hmm.
it is more likely than not that the market is correct. But
Mm-hmm.
take that for what it is. This is not investment advice. I'm not
Yeah,
advising
yeah,
you
yeah.
to go and
Right.
yeah.
Yeah, but you're not personally going long on Credit Suisse right now, I'm assuming.
No, I officially I can fully disclose I have no position in the stock.
Um, okay, right. So again, like you said, we well, this is really interesting. Oh, hey, Mad Merc is in the chat. Please greet Mad Merc. He hasn't been able to join us on the show for a while because he's busy with real life. But so glad to have him dropping in. Um, uh, right. So it sounds like tell me if this is true. It sounds like this happens a lot in these things. You you have indications, you have sort of arrows, you have smoke, but you don't know what the fire is. Does that happen quite a lot?
Yeah, that's right. Because
Okay.
financial reporting is done typically on a quarterly basis.
Mm,
So you typically have indications in the market before you have indications from the company itself.
official, yeah, an
So
official report or something, right? Right. Yeah, and the companies don't go bankrupt on the the time of their quarterly financial report, probably very often, right? It happens in between, and so everybody's kind
yeah.
of guessing what in the hell is going on over there, right?
Now, there's a very interesting curveball to the credit markets for Deutsche Bank and Credit Suisse, because Deutsche Bank and Credit Suisse aren't just normal, don't just have a normal set of creditors. They have a group of creditors that have what are called capital contingent debt. And those creditors are all, well, overwhelmingly government bodies in uh, Europe, in various jurisdictions in Europe. And the way that these capital contingent uh, debt securities are structured is that if one of a series of financial regulators in Europe determines that Credit Suisse or Deutsche Bank uh, are improperly capitalized, and they've got a formal definition for it, but
Mm-hmm.
you know they have some discretion in the matter. Then they have the right to convert these debt securities into stock and take control of the institutions.
Oh.
So you're in a position where uh, there's a standing vehicle to nationalize the institutions in the event of a lack of capital.
Well, I'm sorry. So you
Um,
you jump from there's this sort of safety net mechanism or something for this to be taken over, and then you said nationalized, which implies that the people taking over would actually be the government or
that's
governments.
right, because the overwhelming majority of the capital of the holders of the capital contingent debt are governments.
Got it. Okay.
These were issued during the European debt crisis in the period between 2011 and 2015 as a explicitly as a means for uh, governments to be involved in the unwind of these institutions in the event of a capital problem.
So this sounds a little bit like the like too big to fail sort of like we basically we can't let Credit Suisse go under. We have to have some kind of parachute that gets pulled before it hits the ground, because if Credit Suisse hits the ground in Deutsche Bank, then it isn't just them that goes down. It has ripple effects throughout the system, right? That's
Well,
why they would
this
take
is
these
what makes
measures.
this story so intriguing.
Yeah.
One of these capital contingent debt securities has never been triggered in the history of the financial markets, right? This is
Mm.
something new that was created in the period between 2010 and 2015. There
Hmm.
are a lot of European institutions that have capital contingent debt held by governments at the discretion of regulators. This has never happened before. And so, one of the reasons I wanted to raise it to the show is because you're about to, well, there's a non trivial probability that we're going to witness, a fairly unique event. And it's going to be, it will define kind of the roadmap for how this works for the other European banks should they ever become financially distressed.
Hmm. Okay, so I can't help but put on my hard-nosed Austrian uh, hat here and say, you know, you're supposed to let things fail. I mean, that's part of what the market is about, right? Is that it tells you that, profits tell you that the market is sending a signal that you're using resources in a proper way. Losses tell you that you're not using them in a proper way, and just utter bankruptcy and failure tells you just stop, please just stop and let these resources go to something else, right? So you're supposed to let things fail, right? But it seems like part of what we discussed with the 2008 crisis and the mechanisms put in place, and part of what you're describing here, it sounds like the hope is, well, we just won't let a lot of things fail, and we'll just keep the party going that way. Am I misunderstanding?
Yeah, I mean, it remains to be seen what governments will actually do if they get control of Credit Suisse and Deutsche Bank.
Mm-hmm.
Theoretically, they could unwind them in an orderly fashion.
Yeah,
Um,
so let them fail, but just try to do it in a way that doesn't bring down too many other institutions.
yeah, do it over 6 months or something,
Mm-hmm.
or
Right, right.
whatever
Give
you're going to do.
give people time to find other ways to accomplish what they were accomplishing through Credit Suisse, for example,
Yeah,
in the credit default swap market, etc. Right?
yeah. So it will be quite interesting to see what actually happens. I would tend to suspect that what will happen is a bailout rather than an orderly dissolution. But
Right. Keep them
what do I
around.
know?
Yeah, and I was suggesting to you, and I'd love your comments publicly here. What I was suggesting is, let's say they do a bailout like we saw in 15 years ago with the 2008 crisis. Um, I mean, from an economist point of view, what is the nature of this institution once it has been bailed out, right? It doesn't seem to me it can be quite the same thing anymore. It's sort of a zombie in a way, right? It's no longer
Well,
something that is could be viewed as market generated. It's something that's only there because extraordinary state measures were taken to keep it there, you know?
yeah, I mean, I would argue that Credit Suisse and Deutsche Bank have been zombie institutions
Okay.
since '08,
Oh, okay. Oh,
right?
really? Because they were
And
in a
and now they'll
similarly
be,
similarly shaky situation 15 years ago, and measures were taken to keep them going.
well, the fact that they have this giant bond capital contingent bond position held by their governments
Mm-hmm.
indicates that they're not really private institutions in the way you would think,
Right.
right?
Right. Right. They're public-private partnership somethings, right? Something like that. Yeah.
Something.
Right. Right. Yeah. And so who cares, right? Well, underneath all of these regulations and all the too big to fail and all this stuff, these institutions do actually serve purposes in the market, right? Um, they
Well,
allow, right?
certainly bailing out institutions that are huge players in the derivatives market uh, artificially props up the derivatives market as an
Mm,
institution, right?
right, right.
So It's good for my business, but
Yeah. And I've seen concerns, if you can speak separate from your own selfish interest for a moment. I've seen concerns that the derivatives market feels like it's just on a volume basis, it's just kind of crazy. Like there's just
no, no,
so
no.
much going on. You don't believe that?
Radlib, bankers' lives matter. All right, it's very important that the derivatives market continue to grow.
Gotcha. Okay. Anything else on Credit Suisse and Deutsche Bank? I think part of what you and I have tried to do is be, how do we say it? It's not about being prophetic exactly, but um, we want to be a little bit ahead of the curve and not do the financial news thing of, hey, that just crashed. Wow, we didn't see that coming. We
Yeah,
try to give the context so that if certain things happen, which things can go lots of different ways. We can't guarantee the future, right? But if certain things happen, our listeners will have a context for understanding, right? Like Credit
let's call
Suisse
it
and Deutsche
directing their
Bank.
attention.
Yeah, directing their attention. If Credit Suisse and Deutsche Bank don't make it to the end of 2022, our listeners should not be like stunned by this, right? They have some context that there was fragility there. There were serious concerns in the market. There was a long run trend. It wasn't just something that happened because of Putin invading Ukraine or something like that. A long run trend for many years. And as you just mentioned, 15 years ago, they already were in trouble and have been propped up since then. So there's a whole lot of context there to understand what happens next, which might look like they disappear as institutions. It might, like you said, more likely look like some extraordinary government interventions take place, right?
Yeah, well, we're gonna see. So
We'll see. We'll see. Okay. Anything else to touch on this before we wrap up with our final story?
let's go on to our friend Mr. Biden and his trouble with the Saudis.
Right. Okay. OPEC. Why does it say plus? Are they called OPEC plus now?
They're called OPEC Plus because they've got Russia in them now.
Oh, I think I didn't really know that. So it's the traditional countries we think of as OPEC, which would be like what Qatar, Arab Emirates, Saudi Arabia, folks like that, right?
Yeah.
And they've got Russia in there.
Yes. So
All the
Russia
point
got
being,
a
they're
seat at
all
the OPEC Plus meetings
okay.
uh, like 6-7 years ago, something like
Yeah,
that.
it's okay. That's been in place, right? But what they all have in common is that they're the major oil producers in the world, except for America, which I think is also the United States is a major oil producer. I don't know. Is it a big exporter?
It is.
Okay. So,
Not anymore. It was a big
oh, okay.
exporter prior to 2020, and then stopped being a big exporter.
Okay. So, right. Anyway, the United States is sometimes a big player in the oil market. Most of the rest of the other big players are in OPEC plus at this point, is what you're telling me, right?
Yes.
Okay, got it. So anyway, OPEC plus to cut oil production by 2 million barrels per day to shore up prices, define U.S. pressure. Okay, I grew up with the OPEC crisis in the 70s and people lining up at the gas station and all that stuff. Um, okay, so this is sort of like, what are they called? De Beers or whatever, and diamonds in South Africa. There's
Yeah.
they don't independently just let the market find its price, right? They actually
Yeah.
are.
So this is
This is actually a
classic,
cartel.
like, nah. Yes, this is classic cartel pricing.
Yeah.
OPEC Plus gets together in order to manage supply, in order to cartel price, in order to maximize the aggregate revenue out of the oil market.
Got it.
OPEC Plus controls like 70 or 80% of the oil export market, something like that. So
Wow.
enough of it that they can enforce a cartel, more or less.
Mm-hmm.
Especially since the decline of the Venezuelan oil production for export and the decline of the export market from the United States.
And I gather that despite the United States backing Saudi Arabia to the hilt and giving it weapons and backing its horrific war in Yemen and all this stuff, OPEC does what the hell it wants to, and the United States really doesn't seem to have much influence when it comes down to
Well,
it.
you may have noticed over the last 4 or 5 months, the Biden administration making repeated diplomatic missions to the Crown Prince of Saudi Arabia,
Right.
and coming back with very little in their hands each
Yeah,
time.
that's I
And
gathered
this
that. Yeah.
is, yeah, this is the ultimate result here. It turns out that Mr. Biden has very, very little influence over the Saudis. He wants them to increase production, and their response was 2 million barrels less.
Wow. So they didn't just he wanted more barrels per day, and their answer was, "All I can do for you is 2 million barrels less."
Yes. Well, you know, those line cities we were talking about a couple of months ago, they don't build themselves.
Right,
You
right,
need serious dollars to build line cities in the desert. So,
right, right. Okay, so why are they doing this? We had seen high oil prices earlier this year. It says, yeah, oh, here we go. The article has it. More than $120 a barrel in early June, and now it's at roughly $80 a barrel. But I mean, that isn't that just sort of a return to normal? I mean, in fact, it
I
wasn't even a
mean, what
return
is
to
normal
normal.
at this point?
Well,
It,
yeah,
it
but
would have been a return to prices higher than the pre 2020 norm.
the $80 is a return to prices higher than the 2020 norm, right?
Pre 2020 norm.
Or pre 2020. Sorry, pre 2020. Okay, that's
So,
what I thought.
if we
Because
remember our history of oil prices prior to 2020, oil prices had been stabilized by large U.S. production for some 4 or 5 years in the range between about $50 and $80. In 2020, there was this really strange demand event that actually resulted in negative oil prices for a
mhm,
period of time.
yep.
Uh, and then since then, we've seen the recovery of oil prices, a peak at 120 earlier in the summer, and then we've had a retracement as the global recession has kind of unfolded.
Yeah, so I'm tempted to say that they seem a little spoiled that they got used to higher prices and they just don't want to go back to the pre 2020 norm, right? Is that unfair?
Well, uh, they're a cartel. They think they can maximize their revenue this way. So,
Give
you
it a
know,
try, right?
maybe they're right. We're gonna see.
Yeah, so what is
But
the
in the
force pushing?
meantime, 2 million barrels a day less on the market means
Right.
the higher prices. So
What is the force pushing against them? Why don't they, you know, like we like to say about minimum wage? Why don't you set it at $1 million an hour, right? Like why don't they decide that they want $500 a barrel or whatever? What is it that or is this just the usual maximization thing that they know that demand will slacken as they go above a certain price, and then their overall revenue will be less, and so they're trying to find the sweet spot, I guess.
yeah, I would say that that's what that's going on in this
Mm-hmm.
particular case. Um, there's a political angle to it as well because they
Oh.
know if they cause too much pain in the West, then the West might actually start drilling for oil because they control about 70% of exports, but they don't control anywhere near 70% of reserves. So,
Mm-hmm.
you know, tomorrow morning, the US or some European countries could decide that, you know, actually we don't care about preserving the natural habitat of the ground squirrel. It is, we're actually going to drill there
Right, right.
and drill for oil. So there's that dynamic to play out as well.
Yeah, and I keep seeing stories about the U.S. oil reserve having been drawn down quite a bit under Biden.
Oh, the strategic reserve, yes.
Strategic oil reserve. Yeah, do you feel like that's an important signal or
I mean, so it is worth it. People should know that this is going on.
yeah.
So when the price of oil peaked in the summer, the Biden administration's response was to release, I think it's a couple million barrels a day from the U.S. Strategic Petroleum Reserve, which is meant for times of war.
Mm-hmm.
They've drawn down about 35% of the reserve.
Oh,
It's
okay.
at its lowest level since the early 1980s,
Oh, wow.
when it was still under construction.
Oh,
So it's never been drawn down at this level ever in its history.
huh.
At this rate of drawdown, there's about 16 months worth of reserve left in the strategic reserve based on the last data that was published in August. So it's like a pretty serious thing that they're doing.
I have to say, it seems a little over the top for them to draw down to such a historically low level in the middle of what crisis exactly? I don't really get it.
Well, especially given just from a prudential standpoint, the U.S. is probably closer to major war now than it has been since like 1990. So you might need that strategic reserve for, strategic things.
Yeah, you don't use up your
Um,
strategic reserves right before the crisis. It's you save it for the crisis. But you're saying we
yeah,
have a
it's
potential
supposed to be
crisis.
there so that like U.S. fighter jets can still fly
Mm-hmm.
in case of
Right,
like war with Russia or something.
right.
Um,
But they're burning
so
through it.
they're burning through it in order to manage the domestic economy so that the bread and circuses can go on. I suppose. I
The,
guess.
the midterms, maybe after the midterms, they stop or something. I struggle to understand how they operate. I have to say. Um,
Yeah, so it's something worth knowing that's going on. At some point, they're going to have to stop that,
mhm.
whether it's when the reserves get to zero or at some more sensible point before that. So, we'll see.
Okay. All right. Shall we go to just? I think we've got two questions right now. That one of which I think is a great one for you. Ready for that to leave this story?
Sure.
Okay. Then Sam153 sent a subscribe star tip, and he says Swiss neutrality seemed to be its biggest asset for years. Their nation seems to have neglected this for a while now. Is this a factor in their banking crisis? Really good question to ask Blackhorse because he has previously helped us understand how Canada actually, maybe not exactly like Swiss neutrality levels, but Canada has had a position in like South America of being like the place you can trust to put your money, right? It's had that kind of trust that Swiss banks had. And then that got compromised with some of the lockdown measures and going after people financially because they were resisting the regime and stuff like that. Anyway, we'd had a previous conversation about that. So really interested in on your perspective on Sam's question about Switzerland.
Yeah, so Switzerland compromised their historic reputation for banking privacy shortly after '08 as part of a condition of the bailouts that were done at the time. Uh, the IRS and other agencies got an opportunity to look at the financial records of UBS and Credit Suisse for the first time in their history.
Huh.
So that reputation for strict neutrality and strict privacy is something that I would in fact of that level of privacy ended as far as I can tell in the '08 crisis, but
Mm,
obviously the reputation lasts a little bit longer. Not
yeah.
everybody sees every event that occurs.
Right.
I would say that you're looking at so we talked about chronic problems and acute problems. The
Yeah.
unique reputation of Swiss banks has been suffering because of their connection to the international financial system for some time. And I would
Mm-hmm.
say that that's a significant part of their chronic problem, right?
Oh, okay.
They're
You
in
so you
business.
you think he's on to something there. It is part of the long term trends we're seeing with Credit Suisse, for example.
Well, I would say that Credit Suisse, if it had continued to be highly private, uh, could have had a different long-term business outlook, right? It
Mm-hmm.
could have had a different business niche than it presently has
Got it.
because of the positions that it's taken over the last 20 years that have forced it to open up its privacy. It's now one of the big international banks rather than kind of a unique thing.
Got it. Hey, we got one on the screen. That's nice. Lady of Shalott. Oh, the irony of the U.S. asking the Middle East to bail them out for their self inflicted energy mess after their foreign policy meddling in that region. Uh, right. Yeah. So U.S. Invades Iraq, etc. Syria, involvement in Syria causes all kinds of chaos in the Middle East. And then gets into a sanction on, is in pushing for sanctions on Russia, which causes problems mostly for Europe, but I guess US has been affected too, and then goes back to the Middle East and says, help us, please. And I don't know, maybe that's part of the reason that
Well,
the crown prince of Saudi Arabia isn't being so warm.
I'm not an expert in geopolitics, but I
Yeah, yeah,
know enough to know that the Saudi Arabians are very unhappy with the Iranians, and the Biden regime's effort to resurrect the Iran deal to unfreeze Iranian assets and get them into the international markets uh, is probably not sitting very well with the Saudi Arabians. So I suspect that's a key element of the negotiations with OPEC Plus, because uh,
uh,
the Saudi Arabians have a very disproportionate influence on OPEC Plus's behavior historically. So, uh, if you look at who's on that board, Saudi Arabia is a big player, Russia is a big player, the Gulf states are big players, Indonesia is a fairly big player. None of these regimes are particularly happy with the Biden regime's behavior at the moment in the foreign policy realm. So I would say that they're all, disinclined to acquiesce to his request.
right. Yeah, well, Academic Agent has been very excited by the revolution being led by teenage girls in Iran.
Yeah.
He just can't wait to see the teenage girls bring down the Ayatollah. So anyway, that's a joke. But okay, one more super chat from oh wow, Odra Noel Zenitram. Um, he, in this case Musk, clearly Elon Musk really likes that Weibo or WeChat style crap where everything is in an app. Very sus. Yeah, I don't know. I hear you. I'm inclined to be a little more open minded just because I recognize that this goes way back. I don't know if you remember this, Black Horse, but they went after Microsoft because it was bundling um, the browser in with the operating
Yeah.
system or whatever, right?
Yeah.
It's very difficult as we go into new technologies and social media and stuff like this to know what the right answer is in the market for should things be unbundled or bundled. And I take a very, laid back attitude of let the market figure it out. Should the browser be part of the operating system? I mean, at this point, can you imagine buying a Mac or a Windows and there's no browser and you got to go download it first somehow without a browser? I mean,
Yeah.
it seems crazy, right? I mean, it feels like the market wandered its way with a lot of controversy towards the right answer, which is that a web browser is as important part of your turn on the computer experience as an email program or something like that, right? So in regards to bundling Twitter along with some other types of services into like one stop shop where you open it up and not only do you tweet, but you also do, I don't know, other things in your X app or whatever. Maybe that's the right answer. If it isn't, people won't want to use it. Right.
Yeah. Like I've built product in in the software industry before and
Mm,
seen product succeed and seen product flop, and it's quite a the dialogue between what you think should be the right answer versus what consumers actually want is it's a harsh dialogue, and
yep.
far be it for me to like I know that I don't use social media the way normal people use social media, so
Hmm.
far be it for me to speculate on what most people will want.
Yeah, and that's the other thing is you'll have the nerdy guys, speaking from my industry, programmers and stuff, having just terrible guesses because they're not normal, right? They're a
Yeah.
small percentage of the population that has high abstract thought, so rank very high on abstract thought and less on concrete thought. They're more comfortable fiddling than most people are, et cetera, et cetera. All of this results in, you do not want a user interface designed by coders. If you're trying to bring something to market, that is like the last thing you want. It'll only be of interest to other coders, and probably not even other coders will like it, frankly. So,
Yeah, you'll probably end up with 16 different interfaces for 16 different varieties of programmers,
right, right.
um, and none for the general population. So
Right. Yeah, yeah. So Yeah, and in a way, all you're talking about here is just the challenge of being an entrepreneur, right? Which is, here we're talking about software interfaces, but same thing with car models and et cetera, et cetera. You think it's a pretty cool idea and you bring it to market and then discover for some reason people don't like it, right? And you don't
Yeah.
really
The
know until you get it out there.
the biggest issue with social media is because of the benefits of scale, it's not a natural monopoly, but it's very difficult for new entrants to attack the space.
Hmm.
So, um, it's unfortunate for consumers if the big players make mistakes.
Right.
So,
And that's part of
I
the
mean,
reason
it's
I'm making that prediction about no one really leaving Twitter, or not for long. They'll be like, they'll have a protest week or something off Twitter once Elon Musk takes over, and then they'll be back because it's not so easy to actually get everybody to leave a social media platform and jump to another social media platform together and have a critical mass at that new spot, that new landing place, right? It sounds like something you could just do. Hey, all left-wing Twitter, we're all going to go. It's actually quite hard. It's not obvious how you
well,
would pull that off.
it also sucks if you can't dunk on the right wingers. So, you know,
Right.
there's that as well.
And vice versa. Right wingers want the left wingers around to dunk on them, right? So,
Yeah.
okay, I think we got through some great questions. Thank you for the super chats, and tip on Subscribestar. And we should be back with Left Wing Terror next week with Ryan. In case it's not become clear, we start 2 hours different. With Black Horse, we start when we started today. With Ryan, we start 2 hours later because they're on different schedules. Ryan's taking a class, and Black Horse has a family, and stuff like that. So,
Yeah, I was
but
thinking
anyway,
with your introduction, my daughter's, my 4-year-old is just starting pony riding lessons this week. So,
oh, that's great. Oh, cool.
yeah,
That's good. 4 years old. Wow, that's the way to do it.
yeah,
Um,
she looks very tiny on top of the pony. So,
Even on a pony, yeah, she still looks really small, right? Yeah. Okay, well, thanks everybody. Just thought I'd reveal to you what hopefully has become clear to regular watchers: our sort of 2 hour difference in start time this semester. Might change next semester with Ryan's class schedule, but I am so blessed to have Black Horse on the financial market stuff. He brings so much, and Ryan when we get into history, and as we'll feature more over time, because this is part of what he's learning and learning from one of the best Austrians on this, we will be talking more about entrepreneurship and the role of the entrepreneur in the economy. Ryan's learning a lot about that right now. That's part of the program he's going through. And so I really look forward to hitting that theme more coming soon. Okay, so that's all for this week. Thank you again, Black Horse, and off we go.